You filed your taxes. You reported your CPP and OAS. Everything looked fine. But if you had money in a foreign account that wasn't reported properly, the CRA could flag your return. And the penalties in 2026 are catching many Canadians off guard. I'm talking about unreported foreign income. And this isn't just a problem for wealthy investors. This affects Canadian seniors who moved back home after working abroad. It affects retirees who own a small rental property in Florida or Portugal. It affects new immigrants who still have a savings account in their home country. And it affects snowbirds who think their U.S. bank account doesn't need to be mentioned because they're only there part of the year. Here's what's happening right now. The CRA has ramped up compliance enforcement on foreign income reporting. And in 2026, they're not just sending warning letters. They're issuing penalties that can reach over $16,000 for failures to report foreign property and income correctly. That number isn't made up. It's based on actual penalty structures outlined in Canada's tax regulations, and it's hitting Canadians who had no idea they were doing anything wrong. So let me explain exactly what unreported foreign income means under CRA rules, why enforcement is tightening, and what you need to do before you file your next return. First, let's talk about what counts as foreign income. If you're a Canadian resident for tax purposes, you're required to report your worldwide income. That means income from any source, anywhere in the world. It doesn't matter if you already paid tax on that income in another country. You still have to report it to the CRA. This includes foreign pensions, rental income from properties abroad, investment income from overseas accounts, interest earned in foreign bank accounts, dividends from foreign stocks, and even income from freelance work done for clients outside Canada. A lot of people think that because they paid tax in the United States or the UK or wherever else, they don't need to report it here. That's not how it works. Canada has foreign tax credit systems to prevent double taxation, but you still must declare the income. If you don't, the CRA considers it unreported income, and that opens the door to penalties and reassessments. Now here's where it gets more complicated. Beyond just reporting the income itself, if you own foreign property worth more than 100,000 Canadian dollars, you're also required to file a form called the T-135. This is the Foreign Income Verification Statement, and this is where many Canadians get tripped up. The threshold is $100,000 in total cost. That means if you own a condo in Arizona that you bought for $90,000 and you have $15,000 sitting in a U.S. bank account, you've crossed the threshold. You need to file the T-135. And here's the part many retirees overlook. The T-135 doesn't just apply to real estate. It applies to foreign bank accounts, shares in foreign corporations, interests in foreign trusts, and even certain types of cryptocurrency held on foreign exchanges. A lot of seniors don't realize that the vacation property they bought decades ago now triggers a filing requirement. According to guidance published on Canada.ca, failing to file the T-1135 on time can result in penalties starting at $25 per day, up to a maximum of $2,500. But if the CRA determines that you knowingly or under circumstances of gross negligence failed to file, the penalties get much steeper. We're talking about 24 months of penalties, which can exceed $16,000 when combined with interest and additional assessments. So, why is the CRA cracking down now? There are a few reasons. First, Canada is part of the Common Reporting Standard, which is an international agreement that allows tax authorities to share financial account information across borders. That means if you have a bank account in Spain, the Spanish bank is likely reporting that account to the CRA. If you didn't declare it, the CRA already knows. They're just waiting to see if you'll come forward. Second, the CRA has been under pressure to close the tax gap. That's the difference between what's owed and what's actually collected. Foreign income is a major piece of that puzzle. The government has invested heavily in data analytics and compliance programs to identify taxpayers who may not be reporting everything they should. Third, there's been a rise in cross-border transactions and remote work. More Canadians are earning income from foreign clients, holding investments abroad, and living part of the year in other countries. The CRA is adapting to this reality by increasing audits and reviews in these areas. A common real-world trigger for a CRA review involves seniors who spent part of their careers working abroad. For example, imagine a retiree who worked in the United States for many years, later returned to Canada, and is now collecting a modest pension from their former U.S. employer. Many people assume that because the payments are small, or because the income originates outside Canada, it may not require reporting. However, due to international tax information sharing agreements, foreign pension payments often get reported automatically between countries. When the CRA's systems detect income that doesn't appear on a Canadian tax return, it can quickly flag the file for review. Another frequent situation involves retirees who rent out property overseas, such as a former home in the United Kingdom. Some believe that paying tax in the UK means they're fully compliant. In reality, Canadian tax residents must report worldwide income, and failing to declare that rental income is considered unreported foreign income. New immigrants to Canada face an even higher risk of accidental non-compliance, often simply because they are unfamiliar with the rules. Picture someone who moved to Canada 3 years ago and became a tax resident upon arrival. They still maintain a savings account in their home country, holding about $50,000. Because the interest earned is minimal, they assume it's too small to matter, or they may not realize the account qualifies as specified foreign property. What many newcomers don't understand is that the CRA requires disclosure of certain foreign assets through Form T1135 once the total cost amount exceeds the reporting threshold, even if little or no income is generated. Failing to file this form can lead to penalties, sometimes surprisingly steep ones, despite there being no tax owing on the account itself. Snowbirds are another group at risk. You spend 5 months in Arizona every winter. You opened a U.S. bank account to make life easier while you're there. You keep $20,000 in that account. You didn't think it mattered because you're still a Canadian resident, but that account needs to be reported. And if you're earning any interest or capital gains, that income needs to be declared. Then there's cryptocurrency. A lot of Canadians hold crypto on foreign exchanges like Binance or Coinbase. If the total value of your holdings exceeds $100,000 at any point in the year, that triggers the T1135 requirement. And if you sold any crypto for a gain, that's taxable income, even if the exchange is based outside Canada. Now let's talk about the $16,536 risk. This figure represents the combined maximum penalties that can accumulate when someone fails to file a T1135, doesn't report foreign income, and faces gross negligence penalties. The CRA can assess a penalty of up to $2,500 for late filing of the T1135, but if they determine gross negligence, they can impose a penalty equal to 5% of the unreported income with no cap. And this can be applied for multiple tax years. On top of that, there's interest. The CRA charges compound daily interest on unpaid taxes. If you didn't report foreign income for 3 or 4 years, the interest alone can run into thousands of dollars. And if your unreported income affected your eligibility for benefits like the Guaranteed Income Supplement, you could be required to repay those benefits, sometimes going back several years. This is especially serious for low-income seniors receiving GIS. The Guaranteed Income Supplement is based on your reported income. If you have unreported foreign income, even a small amount, it could push you over the eligibility threshold. The CRA can reassess your GIS entitlement, demand repayment, and cut off future benefits. I've seen cases where seniors had to repay tens of thousands of dollars in GIS payments because they didn't report a modest foreign pension. OAS recipients need to be careful too. If your net income exceeds a certain threshold, your old age security gets clawed back. Unreported foreign income increases your net income, which means you could owe back OAS payments plus penalties and interest. And here's the part that frustrates a lot of people. Even if you didn't know you were supposed to report this income, the CRA can still penalize you. Ignorance of the rules is not a defense. The expectation is that you either know the rules or you get professional help to ensure compliance. So what can the CRA legally do if they find unreported foreign income? They can reassess your tax return for up to 3 years back, but if they suspect fraud or gross negligence, there's no time limit. They can go back as far as they want. They can issue penalties, charge interest, reduce or eliminate your benefits, and in extreme cases, pursue criminal prosecution for tax evasion. But let's be clear. Most Canadians who make mistakes with foreign income reporting aren't trying to cheat the system. They simply didn't know the rules. And the CRA does have programs in place to help people fix mistakes before penalties become severe. If you realize you didn't report foreign income or file a T1135, you can file what's called a voluntary disclosure. This is a program that allows you to come forward, correct your past returns, and in many cases, avoid penalties altogether. You'll still have to pay the tax owing, plus interest, but the penalties can be waived if you meet the program's conditions. According to CRA guidance, the voluntary disclosure program is available as long as the CRA hasn't already started an audit or compliance action against you. The key is to act before the CRA contacts you. Once they send you a letter or start a review, it's too late to use the voluntary disclosure program. So what should you do right now, especially if you're filing your taxes in the coming months? First, go through your financial records and identify any foreign income or foreign property. This includes bank accounts, investment accounts, real estate, pensions, rental income, and cryptocurrency. If the total value of your foreign property exceeds $100,000, you need to file a T1135. Second, make sure you're reporting all foreign income on your Canadian tax return, even if you paid tax on it in another country. Use the foreign tax credit to avoid double taxation, but don't skip the reporting step. Third, if you've made mistakes in previous years, talk to a tax professional about whether you should file a voluntary disclosure. This is especially important if you've been receiving GIS or other income-tested benefits. Fourth, keep good records. The CRA can ask you to prove the source of your income and the value of your foreign property. Bank statements, property assessments, and investment records are all important documents to keep on file. And fifth, if you're a new immigrant, understand that your tax residency starts the day you become a permanent resident, or the day you establish significant residential ties in Canada. From that point forward, you need to report your worldwide income, even if you still have accounts and assets in your home country. From a policy perspective, this trend of increased enforcement isn't going away. The federal government has made closing the tax gap a priority, and foreign income is a major focus area. The CRA is hiring more auditors, investing in technology to detect non-compliance, and expanding information sharing agreements with other countries. If anything, enforcement is going to get stricter over the next few years. If you're someone who has foreign income or foreign property, now is the time to get compliant. Don't wait for a letter from the CRA. By then, your options are limited and the penalties are already in motion. This isn't about fear. This is about protecting yourself and your benefits. A lot of Canadian seniors worked hard their whole lives and depend on CPP, OAS, and GIS to get by. Losing those benefits because of unreported foreign income can be devastating, especially when it could have been avoided with proper reporting. If this update clarified your CRA obligations even a little, take 2 seconds right now and hit the like button. It helps this information reach more Canadians who may be unknowingly at risk. Make sure you subscribe and turn on notifications so you don't miss critical updates on Canadian tax rules, CRA compliance, foreign income reporting, and retirement benefits that could directly affect your finances. And if you're unsure about your own situation, especially whether you need to report foreign income or file the T1135, drop your question in the comments below. I personally review the comments, and your question could help protect someone else who is facing the same confusion. Most people don't realize there's a problem until they receive a letter from the CRA, and by then, options can become limited and costly. So please, share this video with any friend, family member, or fellow Canadian who has assets, accounts, or income outside Canada. One simple share could save someone thousands in penalties and a lot of unnecessary stress. Staying informed today is one of the smartest ways to protect your money, your retirement, and your peace of mind.